Ethereum just had a week that tells you exactly where the real pressure is building. This wasn't a normal pullback, it was a structural shift. And if you know how to read the signals, the picture becomes very clear. Today, we're breaking down Ethereum's last 7 days. Futures positioning cracked, spot demand weakened, institutions moved in opposite directions, and the tech side quietly shipped something important. This week showed you where the pressure is building and where the next move is likely to come from. ETF's market structure softened across every major time frame. Price pulled back towards 2100, and the reaction around that level showed hesitation. Spot buyers slowed down, ETF flows stayed weak, exchange inflows increased. That combination pointed to a market that was losing momentum across multiple fronts. And it wasn't driven by one event. It was a cluster of signals landing at the same time. This is where the story starts. More than $2.8 billion in ETH futures unwound over the last 2 weeks. Taker volume flipped negative for the first time since March. That tells you traders stepped back. ETF flows didn't counter it. They stayed soft. Exchange inflows picked up, which usually means people are preparing to sell or hedge. When futures, ETFs, and exchange flows all lean the same direction, you get clean directional pressure. This week showed a split in institutional behavior. Harvard's endowment liquidated its entire ETH position after 1 quarter. That's a major institution stepping away from risk. But Bitmine went the opposite direction. They bought 60,000 ETH and now hold 4.6 million. Their possession for positional inclusion in the Russell 1000 index in June. The Russell 1000 is one of the largest equity indexes in the United States, and index funds that track it manage hundreds of billions of dollars. If Bitmine is added, those funds are required to buy the stock automatically to match the index weight. That creates forced institutional inflows, not optional ones. So, if you have one institution tapping out and another positioning for mandatory buying pressure, that contrast is what makes this week important. On the tech side, the Ethereum Foundation shipped the Kohaku SDK. Sorry about that. This lets wallets integrate privacy tools like Railgun and privacy pools without centralized relayers. It strengthens user-controlled privacy. It doesn't move price today, but it matters long term. Sentiment took a hit too. A whale trader tied to the former Bitforex CEO is down 128 million on leverage ETH logs. Losses like that don't just hurt one trader. They affect liquidity, positioning, and the willingness of others to take risks. That's why this week felt heavy. Ethereum didn't break down, but it was tested. The next week depends on whether demand stabilizes before the next wave of flows hits. If ETF flows improve and futures positioning resets, ETH can recover quickly. If not, 2100 becomes the next battleground. Either way, the signals from this week give you a clear read on what matters next. So if you want a clear framework for reading weeks like this without getting lost in the noise, Well, that's exactly why I wrote Understanding Crypto. It breaks down how flows, structure, and sentiment fit together so weeks like this stop feeling random. Of course, I'll put a link in the description. And if this helped you see Ethereum's week more clearly, like the video, drop a comment with what you're watching next, and make sure you're subscribed so you don't miss the next breakdown. Stay locked.